In today's Money Watch, we are in the middle of the so-called Santa Claus rally on Wall Street. The New York Stock Exchange explained it this way yesterday on X. Quote, historically, the Santa Claus rally refers to the tendency for markets to rise during the last week of December and the first 2 trading days of January. The seasonal boost often sets a positive tone for the new year. For more on this, let's bring in Phil Luck, who has an aptly named last name for this segment. He is the director of the economics program at the Center for Strategic and International Studies, more commonly known as CSIS. So, Phil, the Dow Jones did lose almost 250 points yesterday, but what can you tell us about this Santa Claus rally?
Yeah, so it's an interesting market phenomenon that in some ways has a very little to do with the underlying health of the economy, but can tell us quite a bit about sentiment in the market. The rally, which you've noted, is basically the last 2 weeks in December and the first 2 weeks in January. The market tends to do pretty well, historically up about 1.3%. About 4 out of every 5 years, the market does really well during this period. This is due to shuffling of tax burdens, buying and selling of stocks, the historically low level of trades, which makes underlying trades, create more volatility. And there's also a behavioral dynamic here, which is basically if you think markets are going to go up because they historically do, they tend to go up because people buy into that. What we can note from this about the economy, though, is sort of more about the underlying sentiment. We're seeing a slightly weaker sort of, Santa Claus bounce than most years, again, only about halfway through it. And that might indicate some softness in the market and some hesitation about the future trajectory in 2026.
Let's talk about the president's comments yesterday, hinting again about a potential change at the top of the Fed. Of course, Fed Chair Jerome Powell, his term ends in May. The president sort of flirted with the idea yesterday of firing him, though he lacks the authority to do so. What do we know about the leading candidates for this, especially in light of what Bank of America Chair Brian Moynihan told our Face the Nation's Margaret Brennan, that, look, if there is a partisan head of the Fed, the markets will react really negatively?
Yeah, absolutely. So, of course, we don't know this for sure, but it seems like we're in a battle of two Kevins, Kevin Walsh and Kevin Hassett. Of the two, I think the candidate that would make markets more comfortable is Kevin Walsh. Kevin has a long history as a Fed governor. He was a Fed governor during the financial crisis. Would be seen as sort of a steady hand at the wheel. He not only as being sort of consensus pick, I think you could also say that he is also a change agent. He's a candidate who not only has deep experience, but also has been quite critical of some of the ways in which the Fed has operated, some of its use of extraordinary measures like quantitative easing. And so this is not to say that he would sort of change things entirely, but he really is looking for a way to sort of change the dynamics of the Fed. On the other hand, we have Kevin Hassett, who I think would be seen as much more of a partisan pick, a former head of the Council of Economic Advisors at the National Economic Council as well in the White House, has spoken quite often recently about sort of the need to lower rates. So I think that would make these spook markets a bit more, showing less concern about the inflationary pressures that lower rates would cause. And the last thing I would say here is, even though the Fed chairman doesn't themselves pick the rate, the FOMC does that as a group, the Fed chairman matters a lot. One thing you can say is because we have so much debt, we have about $38 trillion in debt, even a 1% increase in interest rates would result in about $300 billion per year more the government would have to pay out in interest.
Phil Luck, thank you so much. Come back anytime.